Hello traders, welcome back to our channel. I hope you have a profitable week. In this video we are going to explain the relationships between imbalance and demand or supply zone. But before digging more into, our recommendation is to apply this principle on a clear up or down trend. Looking at the current chart in this video, we noticed a clear up trend with higher high and higher low. Next, we are going to specify the strength of a trend. We use a Fibonacci level and measure from swing low to swing high. A pullback at 50% or lower offers us a better risk-reward ratio if we consider the maximum stop loss at previous higher low. As we can see, each pullback that happened in this chart was at 50% and below. This characteristic makes each of the pullback a high probability buy opportunity. Let's break down the strength of the trend in three types. The first is the strongest one. The main feature of this trend is that higher low is located above the second from last higher high. The feature of the next one is that higher low created at the same level as the second from last higher high. The resistance that becomes the support concept. And the last one, which I prefer the most, is that higher low is located between the second from last higher high and previous higher low. In this type of trend, price tend to pull back at demand zones located at previous higher low. Make sure to like and subscribe. This encourages us to make more helpful videos. Momentum trading is the suitable style that fits the first one. But if we put a conservative stop loss at previous higher low, the risk-reward is very poor. Also, the price can naturally continue to pull back. With a few words, it's a premature entry and we can stay in our unrealized loss for a while before shift to green again. This can be very frustrating. We are not going to exclude any potential entry in this type of trend. We recommend to enter at the order block. On the second type of trend, we have a classic resistance and support entry. This is one of the major and earliest principles that you learn when you first dig into technical analysis. But the cons for entering at this level is the large amount of retail traders and can be manipulated by the big banks. The conservative stop loss is smaller than the first type of trend, which can be interpreted as a better risk-reward ratio. As we can see, on the third type of uptrend we have the best entry level, and the conservative stop loss is smaller than previous types. In a nutshell, each of these types has pros and cons. Does not exist a perfect one. We must have other correlations in order to define a high probability trade. If you want to learn more about our strategy and be part of Premium channel, we offer a mentorship program. Check the link on the description to find more information. Let's continue with our example. We are highlighting the higher high and higher low. The first and the third pullback happened at support level. The second pullback happens below the support level. As we can see, the real market structure is not a textbook example. Each pullback is different for each other, and we are going to explain how to profit from each of them. The first, we are going to make sure that the entry is located below the 0.5 Fibonacci level. We notice that all pullback except the last one completed the criteria. Recommended broker is Longhorn FX. Trade a wide variety of assets with leverage up to 1 to 500. Check the link on the description to find more. The next step is defining the demand zone and the imbalance zone above and below it. Imbalance is a situation resulting from an excess of buy or sell orders for a specific security on a trading exchange, making it impossible to match the orders of buyers and sellers. Usually price visit these zones later on in order to fill this imbalance. We have an imbalance zone on the top. Very close to it is located the demand zone. Next imbalance is located near the bottom. Using this technique, the entry will be at the edge of the demand zone and the stop loss below the second imbalance. This method will protect you from liquidity hunt. In this case, this opportunity offers 1.8 risk-reward ratio. It's not bad, but we should aim for at least 2 risk-reward ratio. We are going to do the same procedure to the next impulse. We notice a demand zone that correlate with a support level. This is a big plus. In this case, we have 3 imbalance zones above the demand, and another below it. Entry at edge of demand zone and stop loss below the imbalance zone. In this case, price bounced right after the touch of demand. Risk reward is 2.5 to 3.8, which is awesome. On the same impulse, we have another demand and imbalance zone below it. If you find yourself in this situation, there are 2 options: to move the stop loss below the second zone, or to divide the position in half and trade both of them with the same rule that you learned in this video. We are shifting to next impulse. We notice 2 demand zone. The first one is near the top and the second one is below the support level. Looking both of them, it is very clear that we are going to trade the second one. We are marking the imbalance zones, and the second one below the demand definitely saved the trade from stopping out. Risk reward in this trade is above 3, very good. On the last one, the demand is located below the support, but above the 0.5 Fibonacci level. And this zone doesn't meet our criteria for an entry. Anyway, let's mark the imbalance zone. As we can see, the second imbalance is located far away from the demand zone, and if we follow our protocol by putting the stop loss below it, the risk reward will be very low. This is another aspect why we don't prefer to enter this trade. I hope you have enjoyed this video and learned something new. Stay tuned for the next one.